Welcome back to the channel, traders and investors. Today, we're diving deep into a fascinating ticker that's been flashing on our hard-to-borrow screener, WLDS, or Wearable Devices Limited. We're going to break down why this stock is drawing attention from a short squeeze perspective, what the numbers mean, and what to watch for. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what exactly is Wearable Devices Limited? WLDS operates in the exciting technology and consumer electronics sector. They're developing a non-invasive neural input interface, essentially allowing you to control digital devices using subtle touchless finger movements. Think about controlling your smart devices or even smartwatches with just a flick of your wrist without physically touching them. They offer modular development kits to enable this. This is a microcap company with a market capitalization of just $6.01 million and an estimated float that's the number of shares available for public trading of around 1.9 million shares. What is cost to borrow and why it matters? Now, let's talk about the core reason WLDS landed on our radar, the cost to borrow, or CTB. When you want to short sell a stock, you first have to borrow shares from a broker. That borrow isn't free. The cost to borrow is an annualized fee you pay to hold that borrowed position. Think of it like interest on a loan. When this fee is high, it signals that there is a strong demand to short the stock, but a very limited supply of shares available to borrow. A CTB fee over 100% annually means it would cost you more than the stock's price to borrow it for a full year. This is a major red flag for short sellers, as it makes holding their position incredibly expensive. Why the stock is hard to borrow right now? For Wearable Devices Limited, the cost to borrow fee is an eye-popping 736.3% annualized. That's a massive number and indicates extreme scarcity of borrowable shares for WLDS. While we don't have CTB momentum or the exact number of shares currently available to borrow, the 736% figure tells us something significant is happening behind the scenes. Our internal composite squeeze score for WLDS, which combines factors like CTB, borrow supply, float size, and momentum, sits at 47.7 out of 100. This isn't the highest score we've ever seen, but the CTB alone is a major indicator that WLDS is a very hard stock to short right now, especially with its small 1.9 million share float. Squeeze mechanics explained. So, how does this high cost to borrow relate to a short squeeze? A short squeeze happens when a stock's price starts to rise, often unexpectedly, forcing short sellers to buy back shares to limit their losses. Remember, short sellers borrow shares and sell them, hoping the price will drop so they can buy them back cheaper and return them, profiting from the difference. But if the price goes up, their losses multiply. When a stock like WLDS is such a high cost to borrow, it makes everyday short sellers hold their position more expensive. If the price starts to climb, or the supply of borrowable shares dries up completely, short sellers can get trapped. They are forced to buy back shares known as covering, which creates a surge in buying pressure, pushing the price even higher and triggering a cascading effect. It's important to remember, however, that a high cost to borrow does not guarantee a squeeze. It can also mean short sellers have strong conviction that the stock will eventually fall and are willing to pay a premium to stay short. Dilution risk check. One critical factor to consider with any potential squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can significantly offset or negate a short squeeze thesis because it adds supply to the market, making it harder for the price to climb even with high short interest. For WLDS, our tech found no recent dilutive SEC filings such as SMINS-1, SMINS-3, or 424B in the last 90 days. This is good news, as it means the company hasn't recently flooded the market with new shares, which helps maintain the current float dynamics. Recent reverse split watch. It's also worth noting that WLDS executed a reverse stock split, or 1-4-3 split, about 59 days ago. A reverse split reduces the number of outstanding shares and proportionally increases the share price. For example, if you had 3 shares at $1 each, after a 1-4-3 reverse split, you have 1 share at $3. This reduces the float, which, in theory, can make a stock more prone to volatility or a squeeze if demand outstrips the now swallow supply. Historically, many microcap stocks tend to see renewed volatility or a price pop within about a month after a reverse split, though this is a pattern, not a guarantee. While WLDS is now past that initial 1-month window, the reduced float combined with the current hard-to-borrow status keeps it interesting. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's look at WLDS's recent price action and volume. Today, WLDS is up 3.27%. Over the last 5 days, however, it's done 12.76%. Let's zoom out to the last 30 days, and WLDS has seen a significant gain of 59.12%. Now, for volume, today's volume for WLDS is only 97,000 shares. This is drastically lower than its 30-day average volume of 3,181,123 shares, putting its relative volume at almost Xerox average. This extremely low current volume, despite the high CTB, suggests that there isn't significant trading activity or immediate buying pressure right now. What we'd look for in a potential squeeze scenario is a sudden surge in buying volume, sustained price momentum, and further constriction of borrowable shares. Short covering would manifest as buying volume as short sellers exit their positions. Wearable devices limited presents a compelling case study for understanding hard-to-borrow stocks. With a massive 736.3% cost to borrow and a small 1.9 million share float, WLDS certainly has some of the technical ingredients for potential volatility. However, the current low volume indicates a lack of immediate interest, so it's a situation to watch closely rather than one that suggests an imminent event. We'll be keeping an eye on WLDS and its CTB trends. If you found this breakdown helpful, please smash that like button, subscribe for more in-depth analyses, and let us know in the comments what other tickers you want us to investigate next.